Hello, I'm Chris Mercer. I'm at Mercer Capital and our worldwide headquarters, sitting here today. Today's valuation lesson is a single point lesson. It relates to sellers beware. The fair market value of the proceeds that you get from a buy-sell agreement transaction may not be real. And the problem may well lie with the promissory note that you took or might take. I raised this issue in my book, Buy-Sell Agreements for Closely Held and Family Business Owners. And I said then, very briefly, even with a stated funding mechanism, the economic or present value of any redemption price set by the agreement can be significantly reduced because of an inadequate interest rate or excessive risk to be borne by the selling shareholder. The situation is this. A fair market value process has just been undertaken and completed. The company is worth $50 million, the equity of the company, 7.4 times EBITDA, plus cash less debt, and then the interest is a 20% interest. So the interest is worth $10 million, and that is absolutely, positively the fair market value of the interest. The funding, though, calls for a 20% down payment by the company, and then the issuance of a promissory note for the remaining $8 million. The promissory note is a $2 million down, an $8 million note, 2% for 10 years, or $891,000 per year. Sounds pretty good for the company, but what about for the shareholder? If now we take a look at the note, we may see something different. So let's appraise the note. The note is illiquid. It has no basic protections. It is unsecured, and it is at a precarious position potentially in the capital structure of the company from the viewpoint of a shareholder who would be, a former shareholder who would be holding that note. So let's assume that an appraiser said that the appropriate interest rate for that note in terms of its fair market value is 6% and not 2% as stated in the buy-sell agreement. Well, what is that note worth? Well, I said that it's a 10-year note and the annual payment at 2% is $891,000. I took a little spreadsheet, you can do it with a calculator, and took the $891,000 a year and discounted those cash flows to the present at a 6% discount rate. Now, what answer did I get? Did I get $8 million? Well, no. I got $6.6 million. That's a discount of $1.4 million from the face amount of the $8.0 million note, or an 18% discount in terms of fair market value. In terms of fair market value of the whole $10 million, it's about a 14.5% discount. The issue here is that the fair market value of the stock, which was $10 million, is not conveyed to the selling shareholder because the fair market value of the note is substantially less than that of the stock for which it is being transferred. So what can you do about this? Well, number one, you can look in buy-sell agreements for closely held and family business owners. In there's a checklist on promissory notes, or you can go to mercercapital.com/products, and you can find that checklist, or on my blog, chrismercer.net/store. The checklist is available, and it would be helpful to you. Take the book, take the checklist, and have the parties talk to each other, because if they reach agreement today and reflect something that's reasonable for all parties in the agreement, problems in the future will definitely be avoided, and selling shareholders are more likely to get fair market value for the fair market value they're giving up.